Hey investors, I'm Ernie from Shark Investments Research. We all know there's a lot of reasons why folks like to have quality dividend stocks in their portfolio. If you're a believer of MJ DeMarco's fast lane mantra, you put dividend paying stocks in your paycheck account. Some people believe in investing a little bit each month, say 10%, and they want to get something back for that. Dividend stocks is the way to do it. Now, I'm not trying to tell you which is the best method or process for buying stocks. What I am here to do is to give you some quality dividend investments that you can consider for your portfolio. Come on, let's dive in right now and take a look at some good payers from the electric utility out west batch of companies. We are starting out with Avista Corporation. They are ticker symbol AVA. Their dividend yield is 4.7%, and that's on a share price of $35.71. That is effective 24 October 2020. This yield box is filled with gold because that is greater than the average yield for the utility sector. We can see that they are not qualified in cash flow per share or earnings per share, but they are a Div 0. That's 17 years of increasing dividends per share, no flat years in there. Let's take a look at that graphically. The long-term trend, we can see a generally upward trend on the cash flow and earnings, and the dividend trend is relatively smooth upward trend, just the kind of thing that you like to see in a utility dividend stock. Nice smooth upward progression so that you can count on it and plan for it. All right, year-to-year changes. Again, we can see some of these ups and downs on the cash flow and earnings, but those dividends are all above the zero line. That's what we're looking for. Now, we are comparing them to Edison International. Their ticker is EIX. They're also 4.7% for a yield, and that's on $56.27. Again, effective 24 October 2020. Edison International is also not qualified in cash flow or earnings per share. They are also a Div 0. 17 years of increasing dividends per share. Now, their long-term track record is a little bit different. They had a nice jump in 2005. They were steadily moving up, and then they started having some problems here in the last couple years. Look at this, their earnings per share actually dipped below the dividend payments a couple times. But the dividend payments, what we're looking at, is relatively smooth, not necessarily as strong an upward slope as Avista, but still an upward slope, although you have to get a little bit concerned when you see this kind of stuff going on, how well they'll be able to maintain those dividends. Year to year, here we go. You can see that jaggedness here in the recent years, and the dividend yield always above the zero line. The third company that we're going to look at, this is going to be kind of interesting, Northwestern Corporation, NWE. They're also 4.7%. So yes, I've picked the three top dividend yielding companies out of 11 that were surveyed in the Value Line Investment Survey. There were 5 that were qualified. I picked the top 3 to look at. The other companies, by the way, that were available were Black Hills and Sempra. But we are just looking at the top 3 payers in this group. Okay, back to Northwestern, 4.7%, and that's on $52.69. Again, effective 24 October 2020. Also not qualified in cash flow per share or earnings per share, but they are a div 0 just like the other two. 17 years of increasing dividends per share. Their long-term trend, now this was an adjustment due to some deferred expenses. I wouldn't get too wrapped around the axle about what's going on here. If we look from 05 on, we see a relatively smooth upward trajectory, almost, I mean, it's not flat, but it's not great, but it's also not jagged. So roll that into your thoughts on that. And more importantly, we see that the dividends are a nice smooth upward slope. Year-to-year changes, the scales are a little messed up because of this one big adjustment year here, but otherwise you see the dividends are all above the 0 line. This will get cleaned up here in a year when we can adjust this data to get rid of this spike. Well, let's lay these all out next to each other. That's the best way to do these comparisons. Looking at the cash flow per share, the purple dashed line is Edison International. The red dots are Northwestern, and the solid blue line is Avista. So we see that Edison International, for the most part, is outperforming, but we get this kind of jaggedness here at the end that we looked at earlier. That needs to be considered, but still outperforming both Northwestern and Avista. Avista, a bit of a rocky run there. Northwestern, a little more stable and upward trajectory. Earnings logically would follow, but we see this adjustment here. Again, I wouldn't get too wrapped around the axle. If we just look from 2005 onward, we see again Edison International outperforming until we get into these difficult years here recently. Northwestern, good, steady performer here. Avista, another good, steady performer. So, this kind of muddies the water a little bit for your analysis. And then in the dividend per share, now remember, all of these companies, Avista, Northwestern, Edison, they're all paying 4.7%. So this is a real nice comparison because you can really clearly see the difference in that, what that dividend yield percentage means relative to the share price. So here we have Edison outperforming because that's 4.7% on $56.27. But they didn't start outperforming the group until 2016. But prior to 2016, Northwestern was outperforming. And Northwestern is really not that far behind, 4.7% on $52.69. And then here you have Avista, 4.7% on $35.71. So as you consider your dividend portfolio, you've got some choices. You may not choose between all these. You may just pick, spread amongst the three of them. You might go with Edison because they're the top performer right now, and then modify as you need to. Now, for some people, though, let's be realistic, $56 a share might be something that they don't want to get into. There's a number of people out there. There's this idea that you don't pay more than $40 a share, in which case Avista is your play. So there's a lot of things to consider. I also encourage you to take a deeper dive into the rest of the information on these three companies. The areas that they serve. Are they exposed to the costs of nuclear energy? Are they primarily coal or oil? Are they investing in new renewable sources? All of those issues need to be considered for your investment portfolio. All I'm trying to do is help you with one significant piece of the pie, and that is who is giving you the best bang for your buck from a perspective of a long-term quality dividend payer. If you are looking for more dividend stock recommendations and considerations, go ahead and look at the rest of my videos. There's some links popping up here. There's good dividend payers across the spectrum of industries, and I try to share with you weekly many that you should consider. Have a great day and good fortune with your investing.